Hello and welcome to Calling Monster Finance. It's September 9th, 2025. Today, the US markets pushed into record territory with a narrative that might seem counterintuitive. Bad news for the economy was treated as good news for stocks. The S&P 500 and Nasdaq Composite both closed at new all-time highs, not on signs of strength, but on the back of a significant signal of weakness in the US labor market. This development has cemented investor expectations for an imminent interest rate cut from the Federal Reserve. Over the next few minutes, we'll break down how this bad news is good news dynamic played out, analyze the key economic data that drove the session, and look at the divergences happening beneath the surface of the major indices, including a notable drop in shares of Apple following its latest product launch. The main story on Wall Street today was one of conviction. Investors showed a powerful belief that the Federal Reserve is on the verge of easing monetary policy, and they traded on that belief with force. The catalyst was a preliminary report from the U.S. Bureau of Labor Statistics, which suggested that job growth over the past year was overstated by a record amount. This news landed decisively in a market already positioned for rate cuts. The sharp apparent cooling of the labor market was interpreted as a clear signal that the Fed will need to act soon to support its maximum employment mandate, even if inflation remains a concern. This prospect of lower borrowing costs provided a significant tailwind for financial assets, pushing valuations higher across the board. The S&P 500 finished the day up 0.27%, while the Nasdaq Composite added 0.37%. However, despite the broad rally to record highs, there was an undercurrent of caution. Today's gains occurred in a relatively quiet period just before key inflation reports. The Producer Price Index and the Consumer Price Index are due later this week. Those releases could complicate the current narrative, especially if they show that price pressures remain persistent while the economy shows signs of weakening. We also saw significant divergence within the technology sector, which largely led the advance. Apple shares fell 1.48% following its highly anticipated iPhone 17 launch, an event that met but did not seem to exceed investor expectations. In stark contrast, shares of Oracle surged in after-hours trading. While its quarterly earnings missed estimates, the miss was completely overshadowed by a massive increase in its backlog of contracted revenue, driven by huge demand for its artificial intelligence cloud infrastructure. This suggests a market that is currently rewarding tangible, large-scale AI growth over incremental updates in consumer hardware. Let's take a deeper look at the single most important driver of today's market action: the revision to U.S. jobs data. At 10 a.m. Eastern Time, the Bureau of Labor Statistics released its preliminary annual benchmark revision. This report indicated that U.S. non-farm payrolls for the 12 months through March 2025 were likely overstated by a staggering 911,000 jobs. To put that in perspective, this is the largest downward revision of its kind on record. It paints a picture of a U.S. labor market that is significantly weaker than previously reported. The market's reaction was immediate and positive. Equity indices, which had been trading near flat, began a steady climb as traders interpreted the data as a definitive green light for the Federal Reserve to begin cutting interest rates. In the derivatives market, the probability of a 25 basis point rate cut at the next Federal Open Market Committee meeting became fully priced in. The debate among investors has now effectively shifted from if the Fed will cut rates to by how much and how soon. This was the pivotal moment of the trading day. The market's enthusiastic embrace of what is fundamentally negative economic news confirms the dominance of the bad news is good news paradigm. The scale of the revision was so large that it appears to have forced the Federal Reserve's hand in the eyes of the market, compelling it to prioritize supporting employment. This perception is the primary force that propelled the S&P 500, Dow, and Nasdaq to new record-closing highs. Turning to commentary from key public figures, President Donald Trump's administration was active on the policy front. The administration formally appealed to the U.S. Supreme Court to challenge a lower court ruling that found certain tariffs to be illegal. This legal battle introduces significant uncertainty for trade policy. Treasury Secretary Scott Bessent has warned that if the ruling is upheld, it could cost the U.S. Treasury up to $1 trillion in refunded tariffs, potentially worsening the budget deficit. On a separate note, a post on the president's Truth Social platform welcomed foreign investment and pledged to make it easier for individuals with great technical talent to build products in the United States. While these policy moves create some conflicting signals for investors, the market today largely looked past these details, focusing almost exclusively on the implications of the weak labor data for Federal Reserve policy. Meanwhile, there were no significant market-moving posts from Elon Musk today. However, news related to his companies continued to generate discussion. A Morgan Stanley analyst commented on the newly proposed $1 trillion performance-based compensation package for Musk at Tesla, describing it as a good deal for investors, given the potential market opportunity in humanoid robotics. Shares of Tesla finished the day with a modest gain of 0.16%. These company-specific developments, while important for Tesla investors, were secondary to the powerful macroeconomic narrative driving the overall market. After the closing bell, we received a major earnings announcement from technology giant Oracle, and it perfectly captured the market's current focus on artificial intelligence. For its fiscal first quarter, Oracle reported revenue of $14.93 billion and adjusted earnings per share of $1.47. Both of these figures narrowly missed analyst expectations. However, investors completely disregarded that slight miss. Instead, they focused on a forward-looking metric, the company's remaining performance obligations, or RPO, which represents contracted revenue that has not yet been booked. Oracle revealed that its RPO had surged by an astonishing 359% year-over-year to $455 billion. This dramatic increase was driven by the signing of 4 new multi-billion-dollar contracts during the quarter, largely tied to demand for AI data centers. In the earnings release, CEO Safra Catz called it an astonishing quarter and noted that the company expects to sign several more multi-billion-dollar customers in the coming months. During the regular session, Oracle's stock closed up 1.27%, but the market's powerful reaction to this earnings report sent the stock soaring by over 20% in after-hours trading, demonstrating a powerful willingness among investors to pay a significant premium for tangible, large-scale evidence of success in winning major AI contracts. While the major indices posted strong gains, a look at sector performance reveals the structural divergences at play. The top-performing sector within the S&P 500 was communication services, which rallied 1.64%. Utilities also had a strong day, gaining 0.71%, as did healthcare, which rose 0.60%. On the other side of the ledger, more economically sensitive sectors lagged. The materials sector was the worst performer, falling 1.57%, followed by industrials, which declined by 0.65%. This divergence suggests that while the market is celebrating the prospect of lower interest rates, there are underlying concerns about the health of the real economy. This split was also evident in the performance of small-cap stocks. While the large-cap S&P 500 and Nasdaq hit records, the Russell 2000 index, which tracks smaller companies, actually fell today, closing down 0.55%. This indicates that investors are currently favoring the perceived safety and growth prospects of larger, more established companies over their smaller counterparts in this uncertain economic environment. Now let's take a moment to recap the closing numbers for today, September 9th, 2025. For the major U.S. indices, the Dow Jones Industrial Average closed at 45,711.34, a gain of 0.43%. The S&P 500 index finished at 6,512.61, up 0.27%. The Nasdaq Composite ended the day at 21,879.49, adding 0.37%. And the Russell 2000 index closed at 2,381.82, a decline of 0.55%. Now for a look at key commodities, currencies, and yields. The CBOE Volatility Index, a measure of market fear, was down slightly at 15.04. The US dollar index rose 0.32% to 97.76. The US dollar to Japanese yen exchange rate was 147.34. The yield on the 10-year U.S. Treasury note stood at 4.07%. Crude oil was up 0.82%, closing at $62.77 per barrel. Brent crude oil gained 0.87% to finish at $66.24 per barrel. Gold futures settled at $3,663.80 an ounce, down 0.37%. And the price of Bitcoin was $111,697.68, a slight decline of 0.24%. Finally, let's look at the top 5 stocks by trading turnover today. In first place was Nvidia, which gained 1.46%. Second was Tesla, which rose 0.16%. Third was United Health, which saw a significant gain of 8.64%. Fourth was Apple, which declined 1.48%. And in fifth place was Palantir, which rallied 4.01%. To summarize today's session, U.S. markets rallied to new record highs, driven by a surprisingly weak labor market report that has all but guaranteed, in the minds of investors, that the Federal Reserve will begin cutting interest rates very soon. This bad news is good news. Dynamic overshadowed weakness in bellwether stocks like Apple and concerns about the underlying economy. Looking ahead, market participants will now be intensely focused on the upcoming Producer Price Index and Consumer Price Index reports later this week. This inflation data will be the next major test of the market's conviction that the Fed can and will cut rates in the near future. If you found this analysis helpful, please hit the like button, subscribe to our channel, and share this video with your friends. The content provided on this channel is for informational and educational purposes only and does not constitute financial, investment, or legal advice. All investment decisions should be made with independent due diligence and in consultation with a qualified professional. While we strive to ensure the accuracy of the information presented, we cannot guarantee its completeness or correctness. Any risks or losses resulting from the information on this channel are solely the responsibility of the individual. The views and opinions expressed in this video are those of the speakers and do not necessarily reflect the official policy or position of this channel. This content is not an offer or solicitation to buy or sell any financial instruments.